Every time you buy a stock, the price you see on your screen is not the price you actually pay. Not because of hidden fees, not because of commissions, because of something that happens in the 35 milliseconds before your order fills. It was designed to be invisible, and across millions of retail investors trading every day, it works perfectly. Almost none of that money goes to the stock market. It goes to a desk you have never heard of. Your broker told you commissions are zero, and that is technically true, but zero commission is not the same thing as free. There is a mechanism that sits between you and the market, taking a small cut of every trade. Invisible by design. It does not appear in your account statement. It does not show up in any fee disclosure you were ever shown. What you are about to see is something Wall Street spent considerable money lobbying to keep complicated and confusing. Most investors assume their broker is a neutral middleman, routing orders to an exchange, earning nothing for the service. When Robinhood launched in 2013 and said commissions were zero, most people assumed they just found a more efficient business model. What they actually found was a different way to get paid, one that costs you more than a commission ever did, but in a way you cannot easily measure. Here is what zero commission actually means in practice. It means you are not paying your broker, someone else's. That someone else is a firm called a market maker, and they pay your broker for the privilege of handling your trade. Think about that for a moment. A firm you have never interacted with paid money to your broker to process your order before it reaches any exchange. They are not paying for charity. They are paying because handling your order is, to them, a profitable business. The question that most investors never ask is, if someone is willing to pay to handle my trade, what are they actually making when they do it? Every stock has two prices displayed at any moment: the bid, what buyers are offering to pay, and the ask, what sellers want to receive. The difference between those two numbers is called the spread, and on a liquid stock, it might be 1 cent. On a smaller stock, it can be 50 cents or more. When you place a market order, the most common type, you pay the ask price, not the bid. The person selling to you receives the bid price, not the ask, and the gap between what you paid and what they received is pocketed by the market maker filling the trade. They bought from the seller at the bid, sold to you at the ask, and kept the spread, without ever owning the stock for more than a fraction of a second. This entire transaction happens in approximately 35 milliseconds, which is faster than a human blink, and well before your order reaches any public exchange. The spread you pay is not random. It is not determined by the market. It is set by the firm handling your order, and they set it to maximize what they capture from you. Citadel Securities, Virtu Financial, and Jane Street are names most retail investors have never heard, yet they process the majority of retail stock orders placed in the United States every single day. These firms are called market makers, and their official role is providing liquidity, meaning they stand ready to buy or sell almost any stock at any moment. Behind that neutral description sits a business model designed to earn money on every trade, no matter whether prices rise, fall, or go nowhere at all. Market makers are not betting on stocks going up or down. They are betting on the near certainty that you will keep trading. Their profitability does not depend on market direction or bold predictions, only on a steady flow of orders, captured through tiny spreads repeated millions of times. As long as retail investors continue to place trades consistently, market makers can remain profitable, even in calm, volatile, rising, or falling markets. Their technology operates at speeds that are not comparable to human trading. Their servers are physically located inside exchange data centers, measured in microseconds, not seconds. That means orders travel a few feet through fiber instead of across the public internet, and the difference shows up before a human can even blink. You are not slower than them by a few seconds. You are slower by a factor of 1 million, and that gap is structural. It cannot be closed through research or skill. No amount of studying markets, reading books, or reacting faster changes where your orders physically start. This is not a criticism. This is a description of how the system is built, and knowing how it is built is the only way to operate intelligently within it. The real cost of the spread, once you put a number on it, is something most investors have never actually calculated. Every trade quietly pays that cost. The average retail investor makes approximately 30 to 40 trades per year, including ETF purchases and automatic investments. Over time, those tiny gaps add up to real money. On a stock priced at $50, a typical spread might be just 2 to 5 cents, which sounds completely irrelevant. But on a $1,000 purchase, paying the ask instead of the midpoint of the spread costs between 40 cents and $1 on that single transaction. Across 35 trades a year on an average-sized portfolio, spread costs alone remove between $75 and $200 from your returns annually. My cost never appears on any statement your broker sends you. It is invisible, and it compounds over time exactly the way returns do. The math on options is far worse. Spreads often run 5 to 10 cents on a $1 contract, making the percentage cost enormous. Research shows spread costs account for 30 to 50% of losses in losing retail options positions. Nearly a third of options losses can occur before the market moves at all. The house does not need you to lose. It only needs you to keep trading. And most retail investors do. Payment for order flow, which the financial industry calls order flow routing, is not illegal. It is disclosed, but disclosed in a way almost no retail investor reads or acts on. The disclosure is buried inside your broker's terms of service, typically in a document called the Order Routing Disclosure, available on their website, rarely mentioned at sign-up. What it says, in plain language, is that your broker routes your orders to specific market makers who have contracted to pay for that access. This is the business model. Your broker earns from the market maker earns from your spread, and you pay the cost that never appears on a statement. The reason this structure exists is that it benefits 3 parties. Market makers get consistent order flow, brokers get revenue, and you get 0 commissions. The party that does not benefit in this arrangement, or benefits the least, is the retail investor, whose order is being routed. In a typical flow, the investor sends an order to a broker, the broker routes it onward, and money flows back to the broker from elsewhere, leaving the investor with the smallest share of the benefit. Europe decided this conflict could not be fixed. Payment for order flow is banned entirely because the EU concluded it creates a conflict of interest between broker and client that cannot be managed appropriately. The United States has taken a different path. The SEC has studied the practice and proposed reforms, but as of today, it remains legal and widespread. Understanding this is not a reason to panic. It is a reason to choose your broker deliberately and to trade in a way that minimizes the cost you pay. There is a simple tool most people ignore. By law, your broker must publish a number called execution quality, and almost no retail investor has looked at it. What you need to say is how close your trades are filled to the best available price, compared to the national best bid and offer at that exact moment. Think of the bid and ask as a spread, with a midpoint in the middle. High execution quality means your order is filled near that midpoint. Low execution quality means you're filled closer to the worst available price, and that happens consistently. Those small differences add up. Across the industry, the gap between the best and worst execution quality applied to 1 year of average trading can cost several $100s on a medium-sized portfolio. That's real money lost without you noticing. Fidelity and Interactive Brokers consistently rank at the top for execution quality because they route orders directly to exchanges instead of selling them to contracted market makers. Brokers that prioritize payment for order flow revenue tend to rank lower. The result is simple. Your trades are filled at slightly worse prices, systematically, every single time. The broker you use is not just a platform choice. It is a structural decision that affects the price you receive on every single trade you make. Most investors make this choice based on the app design or which platform is easiest to use, which means they are solving for the wrong problem. The correct thing to optimize when choosing a broker is not the interface, not the research tools, but the price you actually receive when you trade. Here is the practical system: 5 decisions that reduce how much of your capital disappears into the spread before the market has moved at all. Step 1 is simple and non-negotiable. Use limit orders, always. A limit order specifies the maximum price you are willing to pay, so your order cannot be filled above that level. It removes the market maker's ability to execute you at the worst available price, turning execution from a guest into a constraint you control, and keeping more of your capital working for you from the start. A market order is an open invitation for the firm handling your trade to give you their worst legally permissible price, while a limit order removes that invitation entirely. Step 2 is trading liquid stocks, because the spread on a stock trading 10 million shares per day is typically 1 cent, while on a thinly traded stock, it can be 50 cents or wider. Step 3 is checking the spread before placing any trade. Most platforms show the bid and ask price, and if the spread is wider than 0.1% of the stock price, wait or use a tighter limit. Step 4 is choosing your broker based on execution quality. The SEC requires brokers to publish this data under Rule 605, and comparison data is available publicly and is worth 30 minutes of your time. Step 5 is trading less frequently. Every single trade incurs a spread cost, and reducing trade frequency is the simplest and most underrated way to reduce total spread drag on your portfolio. None of these steps require you to be faster than the market maker. They require you to stop cooperating with a system that profits from your impatience. The spread is not avoidable, but it is reducible, and the difference between a spread-aware investor and an unaware one across 20 years is meaningful. The bid-ask spread is the visible layer, the cost you can now name, measure, and reduce. But there is a layer beneath it, one that happens before the market maker even receives your order. And it is the reason that knowing about the spread is necessary, but not yet sufficient. It is a mechanism that makes certain firms structurally faster than everyone else, not by seconds, by microseconds. When you click buy, your order travels from your device to your broker to the market maker's system, a journey that takes roughly 35 milliseconds. In those 35 milliseconds, firms with servers physically co-located inside exchange data centers can detect that an order is arriving and adjust their quotes before it gets there. The spread you saw when you pressed buy may not be the spread you receive, because in the time between your click and your fill, the price already moved. These are the bots that front-run your trades before you click buy, and most retail investors have no idea they exist. Understanding the spread is the first step. Understanding the bots that read your order before it fills is the second, and that is exactly where the next video begins.